let's start off with the referendum set to be held after tomorrow. And clearly a lot of concerns coming to the fore. Some are worried about violence. Others are saying that investors are relatively cautious. But as you can see, positive day on the NSE 20, a gain of 1.3% for today. Give us an indication of what volumes look like.
Volumes are pretty much strong, and I think just like you said, regardless of the earlier concerns about violence or instability, I think the markets are basically signaling that investors are probably not cautious, but they're actually taking a very bullish approach towards the referendum, as we've seen so far in the equities market, in the forex market, and also in the bonds market.
So clearly a positive day. Do you expect this positivity to, reoccur in tomorrow's session? Also give us an indication of what is going to be happening from an investor perspective on Wednesday. We know it is a public holiday, so investors will be looking out for any kind of news that will be affecting the markets going forward.
I think the feeling largely so far is that if we haven't seen any jittery activities in the market, particularly the equities market, then we don't generally expect to see any such activities tomorrow or moving forward. And as is widely expected, that the referendum is likely to turn a positive vote, which again will probably signal an even bigger rally in terms of the equities market, bonds market, and perhaps even the shilling and the rest of the economy. So moving forward, I think the signals that the market is sending is that it's pretty much confident about the continuation of stability and also a favorable performance of the economy.
Taking a look at Kenya's inflation rate, sitting at around 3.6%, up slightly from 3.5% in the previous month. Similarly, we saw the Central Bank of Kenya decreasing its lending rate, sitting at 6%, so down 75 basis points. We know that this has been an ongoing trend. Where do you expect things to go from here onwards, given the fact that we have seen very strong moves by the Central Bank to try and increase lending? Are we seeing it filter through to the ground?
Well, as far as inflation is concerned, I think largely the small increase that we saw in July compared to June was mainly related to an increase in prices of vegetables and fruits, which again is not expected to continue persisting in the months ahead. Second to that is also a small increase in prices of alcoholic beverages, and that actually was a direct result of the budget, which was read in June, where prices of most alcoholic beverages, beer and so on, were adjusted upward. So that's basically what you're seeing. So moving forward, it is not widely expected that the rate of inflation will go up. In fact, there are expectations that the rate might go down, especially looking at favorable weather conditions, where the use of diesel to generate electricity is likely to be shifted in favor of hydro, which is definitely much more cheaper. So moving forward, there's expectation that production costs are likely to come down, and with that translating into lower prices and inflation.
We know that the Reserve Bank governor has also been relatively concerned about certain commercial banks still having lending rates around 14% and above. When do you expect most banks to jump onto the wagon and try and bring down their lending rates as much as possible? Because we have seen quite a lot of banks coming to the fore and embarking on this strategy. Do you expect most to basically carry on with this by the end of this year?
Well, on the issue of lending rates, I mean, lending rates, as you've correctly put it, have been sticky. Ever since rates on government security started coming down, it was expected that banks would reciprocate, but we haven't seen that coming through. And again, it is also expected that with the current, cut in the policy rate, that should also act as a signal to compel banks to lower their lending rates. However, they have been giving various reasons. I mean, most of which border on, the issues about costs. Contracts, contracts underlying the loans and so on. So the expectation is that in as much as you might not see an instant reduction, but gradually as we move towards the end of the year, new money is coming in, an increase in liquidity, and of course also looking at very, very low yields on government instruments, then there's definitely going to be pressure on commercial banks to start pushing their rates lower. Of course, competition being, a key driver as well.
Isaac, looking at Nation Media, the largest media company in East Africa, came out with fantastic results, pre-tax profit up almost 52%. Just looking at a company such as this one, is a great time to accumulate this media company, given the fact that we have seen a great set of results. Do you think that there's more of this to come?
Definitely, I think looking forward, there's definitely going to be a lot of activity favoring media companies. There's been a lot of anticipation that if the economy continues to recover, more importantly, if the referendum turns a positive note, then there's definitely going to be an increase in business activity, and with it, of course, there's going to be a resurgence in, or even an increase in advertising spend, and of course, that will largely benefit media houses, a nation of which is included. So I think moving forward, there's definitely an increased expectation of better performance and better returns to shareholders. As you've seen, they've already returned $1.50 in dividend in the half-year results. So absolutely, there's definitely a lot to look forward to in terms of media companies.
Isaac, give us a sense of asset allocation and what kind of portfolio strategy you've been embarking on. We know that the bond market has fared far better than the equity market, but both offering various interesting aspects in terms of what investors could be seeing in terms of returns so far this year. What have you been doing? How have you been playing the markets?
I think one of the market favorites, ourselves included, has been bank stocks. Looking again at the issue of very, very favorable spreads, and I think also moving forward in terms of the market dynamics, we still expect banking stocks to perform well, at least second half of this year as well. Again, we would also look at industrials on a selective basis. Markets where I think that have been hard hit in the last 2 years, especially because of rising commodity prices, higher electricity prices, and that having come down, expected to lead to efficiency gains and of course better revenue and earnings prospects for shareholders. So by and large, you're basically bullish in these sectors and services sectors as well.